Welcome back, everyone. Today on the Joseph Carlson Show. If you've been following this channel for a while, you'll know that I follow super investors. Super investors are like really good investors that manage a lot of money, typically over $100 million. So they file public reports disclosing their positions because they're legally required to. On this channel, we review those reports every 3 months, and I try to reverse architect what they're doing, what they're buying, and what they're selling. But every once in a while, these super investors not only give their portfolio updates, but they also give interviews, providing us with better context and better nuance of what they're thinking. And two super investors just did that. The first one being Steve Eisman. Steve Eisman has quickly become one of my favorite people to follow. I think he gives very level-headed advice. I think over the past couple of years, he's been spot on with basically every call he's made. He's actually been incredibly spot on. So I've been very impressed with Steve Eisman. Now, Steve Eisman is the one that you may recognize from the Big Short movie because he became famous for shorting the banks and making a fortune doing it. Now, he just gave an interview and he gave lots of opinions on current events, on Apple, on Microsoft, on what the market's doing right now, and why he's still bullish on this bull market, why he still thinks investors need to be invested today. But we also have another interview from another super investor that has a very different trading style. That's Jim Chanos. Jim Chanos is another investor that has an incredibly successful track record, and he does all different types of investing. He goes long, he goes short, he rides trends, he does macro investing, he does a lot, and he has a lot of opinions that he shares in this interview. So we're going to be looking at both of these interviews, seeing what these investors think about today's market. Now, since it's Friday and we're getting to the weekend, I also want to take a detour to the finance side of TikTok. We'll be reviewing two different finance TikToks like this one.
All right, so I went all in on GameStop. I threw $6,000 and I bought it at an average price of $58.
We'll take a look and see how that one turned out for him. So we have a lot to get to in this episode. Let's go ahead and jump in. Now let's first jump in and start off with Steve Eisman here. He starts off by giving his opinion on the overall market.
Berman. And Steve, you're not just bullish about the infrastructure play, you're bullish about the markets writ large at this point, I think.
That's true. I am.
So what do you see that you love, or I guess it's the absence of anything you don't love?
I like right off the bat, he just says he's bullish on the markets generally. He thinks investors should be invested, and he's invested. So good news there. A lot of times the news has a tendency to highlight negative bias and people that are really cautious. I like that Steve Eisman is just bullish right now.
Well, you know, what I would say is that in bad times, people focus on credit quality and balance sheets. And on good times, they focus on stories. And we're in story time. And there are two extremely dominant stories in the markets today, and that's...
This is spot on, and if you've been investing for the past 5 years, you've seen this firsthand. During the early innings of the pandemic, investors were super concerned about balance sheets of their companies. Can they survive for a couple months without revenue, without earnings? So everybody shifted into turtle mode, balance sheets, looking at the ratios of a company, looking at just if the company can survive. Then just a couple years later, in 2021, it was just story time. Disruptive innovation, innovative technology companies, ARK Innovation ETF going up 300%. Right now, like he points out, we are in story time. Right now, the market's going up. Investors don't care about balance sheets. They don't care about the fundamentals or ratios. They care about stories. Right off the bat, I think he's spot on, and I think it's difficult to not be invested during these times.
Two extremely dominant stories in the markets today, and that's AI and infrastructure. And that's what's driving the economy. And, you know, all the economists who have said that because the Fed's raised rates 500 basis points was going to cause a recession have been wrong. Mm-hmm. And we're just powering through. And I think the only conclusion you can reach is that the U.S. economy is more dynamic than it's ever been in its history. So what's not to be lucky about or happy about?
That explains the momentum.
And he's correct in pointing out that the economists have been completely wrong, predicting a recession over and over again that hasn't happened yet. In fact, one of the indicators of an upcoming recession, which is the yield curve inversion, has not really worked out this time. So a lot of investors that have pointed to that, saying there's going to be an upcoming recession because of the yield curve inversion, have been missing out. So I think it's good to take a step back and realize that all these predictions that these experts were making were completely wrong. The US economy has done fine. The market's growing. Companies are earning more money.
We keep setting new records every day, it seems like.
Yes, I mean, you know, what I would say is, you know, like I had a theory a few months ago that the hidden AI play was Apple. Mm-hmm. And that seems to become consensus like in the last week.
Yeah.
So
now he's kind of congratulating himself, patting himself on the back for getting the Apple AI call correct. And I think it's deserved. He should pat himself on the back. He went on to TV, national television, and just like a week ago or like 2 weeks ago, he said Apple is the hidden AI play. It's right in front of us, but Apple's going to really impress people with AI. And then they did their developer conference and the stock moves up like 10 or 15%. So I think it's worth pointing out that he got another call correct. He's been very accurate with a lot of his calls over the past couple of years.
How did you know that before? Because there were so many questions about Apple and what it was doing. I mean, it's suddenly become a lot clearer that they're going to be a distribution
I'm no tech genius, but the only thing that I know is that if AI is going to broaden out beyond just the cloud, people are going to use it on their phone. And so that means Apple. And it means that my phone that I bought a year ago is probably not going to be adequate. It's going to be obsolete.
Yeah.
So you're going to have the biggest refresh. So look, the next stage in the whole tech story is going to be people are going to buy new phones, they're going to buy new laptops, and that's going to have a tremendous trickle down into the rest of the tech sector.
His theses are never overly complex. Notice how he doesn't go into the intricacies of the technology. He simply just says, if AI is the future and people are making all of these applications, they're going to be funneled through the phone. The way that we access information is through this device. So no matter what way it happens, no matter who creates what app, Apple's still the platform of distribution. They're still the funnel. They're still the toll booth on the freeway, so to speak. And whether or not they can monetize you directly through the App Store, Apple will find other ways to monetize you, like offering defaults or different things. So a very simple thesis, but again, a probably correct one.
So right now I have the 15
Me
Pro.
too.
I have the 15 Pro.
Right.
You're good to go, my friend. You actually don't need to upgrade this phone. If you have phones prior to this phone, you have to upgrade.
Yes.
And so the question is, what kind of upgrade cycle you think we're really on? Is this a multi-year upgrade cycle? Is it a finite one? Meaning, is it 2 or 3 years?
I have no idea.
The numbers that I've seen so far point out that around 5% of the phones right now are the iPhone 15 Pro, and the rest of them are below that. So around 5% of the people will eventually have access to the Apple Intelligence. Everyone else won't. And that's what Apple wants. They want just enough people to show off the features to be trendsetters for everyone else to be incentivized to upgrade.
It's impossible to know at this point.
The economics are going to come as a result of the upgrade cycle. It is less clear to me that they're going to come necessarily from services revenue.
Look, we could say whatever we want at this point because it's impossible to know. I mean, I think it's going to be both. I think people are going to upgrade. I'll certainly get a new iPad. My iPad's a little low.
Right.
I'll get a new laptop because the last time I bought a laptop was probably 4 years ago. Maybe I'll keep my phone. Maybe I won't. And then there's all the services. I mean, it's impossible to say at this point what service is going to do because there aren't any apps yet that you're going to say you're going to pay for the services. So it's all pie in the sky at this point.
If you think Apple is the secret play, but you think it's
not so secret anymore.
Yeah, not so secret. If you are you looking downstream? You say that.
We're starting to do research downstream about everybody else that's going to benefit, and hey, I'm not going to tell you what companies those are because I haven't bought them yet.
Yeah.
But that's what we're working on right now.
Do you hold on to your Apple position? Do you think that this
definitely hold on to your Apple position? It's too central a figure.
Apple's at almost $2.13, and he's saying to hold it. So he thinks it's too central of a company. It's just one that you have to have as a stake in your portfolio.
In the whole story that's going to come.
How do you think about a Microsoft?
Oh, we've owned it for years. Same story.
Same story.
Central figure, but it's Microsoft is not going to be. I mean, it'll be like Apple in terms of you have to figure out who else is going to benefit from all the stuff that Microsoft is doing, but that has to be a core holding.
And what about Google?
Same.
Microsoft, Apple, Google, they have to be core holdings. They have to, according to Steve Eisman. And again, I agree with him 100%. I think one of the easiest plays over the past 5 years, one of the easiest ways to outperform the market has simply been overweighting big tech in your portfolio. To me, these companies have represented in bulk the best risk-adjusted returns. They have the best balance sheets. They have the best business models. They have the best talent working at them. They are global companies with enormous reach. and they've been available to us over the past 5 years at discounted prices continually. So I've had all of these holdings: Apple, Microsoft, Google, Amazon. I've held the majority of big tech over the past 5 or 6 years, and that's been a big outperforming part of my portfolio. So again, I agree with Steve Eisman here. Most of the stuff he says I think is true. I think even today, it's probably best to hold big tech in your portfolio. Otherwise, you risk getting left behind. Then you're behind the ETFs, you're behind the S&P 500, and it's very difficult to catch back up once you start getting behind.
I mean, there are two groups. The groups, there's Microsoft, there's Apple, but then there are the people like Oracle, Google, Meta that have tremendous databases that are going to be used. And then there's going to be all the companies that'll benefit from the broadening out. The big question that I have, and I don't know the answer to this, is there's a thesis out there which I find interesting. I don't know if I completely agree with it.
This is a thesis that's been spread around Twitter. It's been spread everywhere for the past couple of weeks. So listen to this.
Yet that for years, software outperformed hardware. Mm-hmm. And I think there's an argument to be made that if AI is as successful as people think it's going to be, the cost of creating software is going to implode.
Right.
And so that would imply that the moats that some of these software companies have, not all, but some have around their businesses are not going to be quite as high. And so you can make an argument that the revaluation of hardware is going to continue and that some parts of software will derate. I think it's a kind of an interesting thesis. If it's true, it's a very long-term thesis, so there's plenty of time to figure it out, but it's one of the more interesting things that I've heard in a long time.
So the basic idea there, like he says, is that software is getting easier to write because you have coding assistants and coding tools and ChatGPT, which can write code. And if the cost of creating software goes down, it means that software companies lose their moat. And this is a thesis that I really don't agree with. I have a history in software development. I've seen what good software developers do, and it's not just writing code or writing scripts like ChatGPT can do. It's working on very complex, highly integrated software stacks that so far are far more complex than most assistants can figure out. So when I look at this news, this is another thesis that's getting passed around online right now. If we look at this write-up here, this was a document passed around on Twitter where he gave a concise thesis of software companies basically being over. In fact, this is called the end of software. It says as part of this, software is expensive to create. You have to pay people to create it, maintain it, and distribute it. Because software is expensive to create, it has to make money, and we pay for it. Software licensing, SaaS, per-seat marketing, software margins have historically been an architectural envy, up to 90% plus. Margins and zero marginal cost of distribution. So when you add on additional users, it doesn't cost anything for those additional users. Software is expensive because developers are expensive. They are skilled translators. They translate human language into computer language and vice versa. LLMs have proven themselves to be remarkably efficient at this and will drive the cost of creating software to zero. What happens when software no longer has to make money? Vogue wasn't replaced by another fashion media company. It was replaced by 10,000 influencers. Software will not be replaced by another monolithic CRM. It will be replaced by a constellation of things that dynamically serve the same intent and pain points. So that's the whole thesis here, is that basically AI is going to drive software development costs down to zero, which I think is very unlikely based on my experience and what software development really entails. And then not only that, but people will be able to replace software companies like Salesforce, a company that manages your business, manages everything you do, to a constellation of things that dynamically serve the same intent and pain points. So you're going to have a bunch of various things created by different people to replace a big company like Salesforce. I think this stuff is interesting to read. It's thought-provoking, but I don't believe the narrative. I don't think software companies are going to zero, and I don't think we're even close to a point where developing software is going to cost zero. Now let's go ahead and move over to another super investor, this one being Jim Chanos. He's a legendary short seller. He's had an incredible record in his history, and he has a lot of thoughts on what's going on today on a lot of different subjects. He first starts off with telling them what he's advising his clients.
This is I just advised a client on a put basket strategy this afternoon, and right now, what we're seeing in the universe of companies we follow is probably it's as attractive a time as it was in first half of 2021. And I've said publicly that 2021 was the most speculative market I've ever seen in my 45 years of investing. And we're getting back to that. Not quite there, but it's close. And you've seen it with things like the meme stocks again. And
you have two super investors here, and both of these investors are mirroring the same point, saying that the market's being driven by narratives and stories. That means we're in a speculative bull market. So Jim Chanos agrees with Steve Eisman on the nature of this bull market, but they have different ways of addressing the bull market. Steve Eisman believes you have to continually be invested, and Jim Chanos invests quite differently.
My God, we're starting to price SPACs again. I noticed that there's $3 billion of SPACs priced.
Does that give you agita, particularly the run-up we saw in GameStop? And yeah, I mean, SPACs are somehow trying to claw their way out of the grave.
People have always said, well, what about the Fed, per your first question? And I always said, well, give Wall Street enough time. The Fed is not the only one with a printing press. Wall Street does a pretty good job at issuing pieces of paper when people really want them.
I mean, how do you sort of navigate? And you talk about advising folks. You're advising people on a public market, public equity market, at least right now, that is at record highs, at least on the S&P and the NASDAQ.
Yep.
A lot of people would look at historical valuations and say, we're stretched here. What is the advice you give in that situation?
Well, since really the mid-90s, we ran our business where we were long equity markets, we were long indices, and then short our names. And I still think that makes a lot of sense. And where the stock market is going, I have no idea. I started my firm back in 1985. The Dow was 1,300. So I mean, that should tell you something about timing. But the fact of the matter is that with the exception of the far right group of companies on the bell curve, most companies underperform the stock market over time or fail. It's the NVIDIAs or the Teslas or whatever on that far right end that go up quite a lot that give you your returns.
Most companies give subpar performance. That's why if you pick stocks, you need to pick the winners. You can't afford picking a group of losers. In this case, I still agree with Steve Eisman that I think central to any portfolio, you have to have big tech. If you don't have the biggest, most dominant companies in the market that the ETFs are weighting higher, I think it's going to be very difficult to outperform. You can do it, but you have to be extremely selective with your companies and make sure you have very good bets. Otherwise, it's typically good to have a portion of your money in the ETFs, which weight towards big tech companies. Now, it continues on stressing just how speculative this market is becoming.
I think there's a much more speculative nature of this market. And we started to see it in late 2019 when commission rates got cut to zero. And retail began to come back in the market in a big way, in ways they hadn't been in. Prior to that, they'd been investing in ETFs or mutual funds or what have you. And we began to see pre-pandemic speculation in individual names really pick up. And then, of course, post-pandemic, it took off. And you can see it in option volumes and a lot of other sort of quantitative measures that the public is in this stock market in a big way. And that really then means that you have to change your risk parameters, change the size of your short bets, if you will, and be mindful of the GameStops and those kinds of things. On the other hand, generally they chase momentum and sometimes, quite frankly, silly stories. And if you want to be investing, you don't want to be doing that.
If you were looking at...
Don't chase momentum, don't buy because of FOMO, don't chase stories. Now, he goes into a little bit of his portfolio, talking about positions where he's shorting companies where the market believes they're AI winners incorrectly.
I mean, for when we look for companies in our world that have gotten the benefit of an AI, kiss, but are actually going to lose because of AI. So we've been publicly short the data centers, the legacy data centers, because they literally are not designed for AI chips. They have to basically be retooled completely. And all of the infrastructure and hardware in a data center, an old one, is not compatible with the new chips. So people have bid the stocks up thinking they're AI plays. They're actually losers from AI.
So Jim Chanos is far more skeptical about this market than most other investors. And he mentions the fervor in meme stocks and the performance of meme stocks. And he specifically talks about GameStop. And he goes into the numbers behind GameStop.
If you look at the meme
But there's little blips here and there.
Yeah. But if you look at the meme stock class of 2021, which was GameStop, AMC, Bed Bath & Beyond, a number of others, I mean, with the exception of GameStop, they are all down 90, 95, 99%. It was disaster for retail investors, quite frankly. And so I think that it gets to my point that you don't want to be chasing this stuff if there's no fundamentals behind it. Mm-hmm. And I have no position in GameStop, but people are still valuing that company, if we're going to value a business, at 3 times its cash. And even though it's raised all this cash, it's got about $9 a share in cash right now per share. I think the stock's at 25 or 26 or 27. And so you have to believe the business has something, or there's option value to the cash, which is what people believe, that Ryan Cohen will be able to do something. That's really hard to do when you're paying $3 for $1 of cash. And again, so you're chasing the future, you're chasing the story. In bull markets, the future gets a premium. In bear markets, reality gets a discount.
He's again mirroring the statements of Steve Eisman, that in bull markets, the future is about stories and narratives, and in bear markets, it's about balance sheets and credibility. In this case, he's once again warning about meme stocks, saying that if you're investing in GameStop, it's highly likely you're going to lose most of your money. Now, I have 2 different opinions on this. The first one is I believe Keith Gill is totally in the right to be able to share his positions, to be able to share what he's doing with GameStop. All he's really done is held the position, bet on the position, and shared it publicly. I don't see anything wrong with that. And I also believe anyone should be able to buy GameStop without it being halted every 5 minutes of the day. There's nothing wrong with that. But I agree with Jim Chanos that GameStop is not a great investment if you look at any of the fundamentals. And if you're investing in stocks like that, you should be fully aware of the risks you're taking. No one else is responsible for you. If you lose all of your money in GameStop, that's on you, no one else. So if that happens, or rather when that happens, if you lose the majority of your money there, don't come complaining to regulators. Don't believe that someone should have bailed you out. You're making the decision to bet on a highly speculative, risky position. Chasing stories and stories alone that aren't backed by fundamentals is never a smart investing decision. It rarely works out, and in the times it does, it's incredibly unpredictable. So in the case of GameStop or any other meme stock, you can just take a look at the other ones mentioned. Look at AMC. Look at the stock price since 2021. When looking at both of these super investors that both have ample experience in different markets, different environments, both going long and short different positions successfully, they're both mirroring the same thing. They're suggesting that right now we're in a bit of a speculative market. There's a lot of narratives and stories driving valuations of companies, making multiples expand. And it's an important time to differentiate between fundamentals that can support a stock during a bear market and narrative-driven stocks that don't have fundamentals. And once the narrative vanishes, those stocks collapse. So I think it's an important time to be very careful with the individual stocks we're buying. Now, on the subject of being very careful with our hard-earned money, we're going to jump over to the financial side of TikTok. This is a TikTok where this investor, this trader, talks about his GameStop position.
All right, so I went all in on GameStop. I threw $6,000 and I bought it at an average price of $58. Right now I'm down $700, but
we're just off to such a difficult start here. He says that we're going all in GameStop, and it's $6,000, which to most people, that's a lot of money. Like, if you have to work a long time to get $6,000, you're going into work, earning a paycheck, paying for inflated food bills, inflated rent prices, and then what do you do with that hard-earned money? The money you finally get to keep after paying for everything, you throw it into GameStop. GameStop is the bet. That's what you're doing with your money. You're going all in on this. It's just difficult to watch. I hope something happens good, but let's go ahead and take a look here.
Not worried. Back in 2020, if you're new here, GameStop price went through the same shit and it rose all the way to $450. And yeah, it was a wild experience and I see it happening again. And, you know, it's different because back in 2020, there was no TikTok. It was all over Twitter and Reddit. But now with TikTok, I feel like it's even worse. So I anticipate this to shoot through the moon, you know. So I have 94 shares. And also, for shits and giggles,
core to his thesis is it went to this price in 2020. That's when the hype happened, the fervor happened then. And now we have TikTok as like an additional tool in our tool belt.
I made a $57 call by 517, and that one's down $110. But you never know. Let's see, right? Let's follow along. Stranger things have happened, and see where it goes from here, you know? Right now, my portfolio is currently sitting at 5,938. Let's see where it goes. Maybe tomorrow it'll be double, maybe it'll be half of that. Who knows, right? Let's find out. Thanks.
As of now, he's deeply in the red on the position. GameStop is at $29 per share. But like he says, who knows? Maybe it will run up 100%. We'll see. Next up, we have this one here, which is an immediate red flag right off the bat. Even without starting the video, just the frame there, you have someone there and it says 19-year-old millionaire. Red flags are going off like crazy. Anytime I see a video that starts off that way, you know what you're getting into at this point. You just know what this is going to be. Let's go ahead and take a look.
19-year-old millionaire made $8,000 in 2 hours.
The chart is mooning. Look at the chart. We just got a break.
Promising obscene levels of money in tiny amounts of time. $2,000, $6,000 in 10 minutes. One other red flag that went off in this video, getting out of a really low sports car right at the beginning of the video. You know, this is another red flag. So far we have like 3 major ones. 19-year-old millionaire, making money in a short amount of time, getting out of the nice car. This is almost so comically on the nose that it's difficult for me to tell whether or not this is a parody. Maybe it's a parody because they're checking every single box of the fake guru bingo chart. They're checking every single thing. You have 19-year-old millionaire getting out of the nice car. You have making money in a short amount of time. And that's all within like 4 seconds.
Millionaire made $8,000 in 2 hours.
The chart is mooning. Look at the chart. We just got a breakout. Ascending wedge. Oh my God, it's still ripping. $8,000 up, chat. Let's get it, baby. Oh, look, 8.6K up. That's literally almost $9,000, guys. I'm literally making that right now. My position's up 54%, and I bought this 2 hours ago. 54% on your return in just 2 hours. And I've had crazier ones where they go up 500% in 30 minutes.
500% in 30 minutes. You got to get in on this. What are you doing? You're wasting your time. When you're at your job, working your 9 to 5, just think about him earning 500% in 9 minutes. And why other investors like Steve Eisman and Jim Chanos that have incredible knowledge bases of markets and equities and trading and going long and short, why they don't do this, I don't know. They must just be unaware of what this 19-year-old has figured out. And the video finishes with them racing their sports cars. Does anyone actually believe this anymore? Is anyone still being fooled by this type of content on TikTok or social media? It's amazing to me that there's still people making a business off of selling the idea that you can make $5,000 in 20 minutes. You can do so safely and repeatedly. You just have to buy their courses for thousands of dollars or join their trading program. It's incredible to me that this still exists. It's very sad. Hopefully enough education goes around that this type of thing becomes less popular, because from what I see so far, there's still people that believe it. Anyways, that's going to be it for this episode. Hope you enjoyed. See you in the next one.